The U.S. Federal Appeals Court ruled that Donald Trump does not have the authority to impose tariffs the way he did, and that has tossed even more uncertainty into the trade outlook. Let's go to Sal Guatieri on this, Director, Senior Economist at BMO Capital Markets. Thanks for joining us today.
Thank you.
So we know, Sal, nothing changes yet since Washington is going to appeal now to the U.S. Supreme Court. But what's your take on what this does to the outlook of tariffs?
Well, we don't know so far. It does look like this appeal will go all the way to the Supreme Court. Could take weeks, could take months before we get a verdict. In the meantime, at least until October 14th, the current tariffs will remain in place. Now, this ruling could affect the vast majority of tariffs applied on other countries by the U.S., so it's pretty material. Now, if the Supreme Court does rule against the administration, against the tariffs, the administration still has other trade acts that it could use to impose tariffs. So much the same way that it's imposed tariffs on the sectoral goods, steel, aluminum, copper, for example, motor vehicles, it could apply the same ruling for other sectors, other industries. So one way or another, we're going to get stuck with tariffs. It's just a question of what trade act is used to impose those tariffs.
And how long it takes, I guess, to reimpose them if they get struck down. Are we then in a better position, Canada, that is without a deal in place, since maybe we could have some leverage if the court rules against the Trump administration?
Well, for Canada, it's a tough one because right now, really the pain that we're feeling right now, we saw it in the second quarter with our economy contracting, is all because of the tariffs imposed on those three sectors: steel, aluminum, and motor vehicles. Mind you, very large tariffs, 50% on steel and aluminum, less than 25% on motor vehicles when you include the U.S. Content exemption, but pretty hefty. The other items, the other goods that we sell to the U.S., for the most part, the vast majority, are exempt from tariffs. They are going in duty free, and that's all because of the USMCA exemption. So that's what's critical for Canada, is that we renegotiate CUSMA and keep that exemption going for the vast majority of goods to Canada. Now, if this ruling that goes to the Supreme Court, if it does work towards removing the tariffs by the so-called IEEPA, Economic Emergencies Act, again, the administration could impose tariffs on sectorally using other trade acts, and that could be bad news for Canada because we could see tariffs then on lumber, copper already are in place, but a vast majority of other industries could get hit with very punitive duties, 25%, maybe up to 50%. So that would probably cause a lot more pain than the current situation where the vast majority of Canadian goods are still shipped to the U.S. duty-free.
Let's talk about the outlook for the U.S. in the economy. We've seen some weakness. Do you expect that to continue? A lot of people are thinking perhaps they got a one-time hit from tariffs and they won't feel the effect of that in the later half of the year.
Well, the U.S. economy is holding up relatively well. It's showing some resiliency. And the reason is business investment remains very strong. In the U.S., it was surprisingly very strong in the first half of this year. There are several reasons because of that. One is just the dramatic, rapid adoption of AI, and the build out of AI infrastructure is certainly supporting business investment. But where we are seeing slowing is consumer spending. In the first half of the year was quite a bit softer than last year. And overall, real GDP in the U.S. has downshifted to just under a 1.5% annualized rate in the first two quarters of the year. So well below what we were seeing, growth close to 3% last year. So the economy is taking a bit of an impact. We are clearly seeing that more in the labor market because job growth has slowed quite dramatically in the last 5 months. Non-farm payrolls are averaging gains of about 80,000 per month, much weaker than about half the norm, in fact. So we are seeing some clear signs of slowing in the U.S. economy, in the labor market. We do expect some pickup through the second half of this year, modestly, and then more of a pickup next year. That's assuming trade tensions stabilize and the Federal Reserve cuts interest rates. We are expecting pretty significant reductions by the Federal Reserve over the next 1.5 years. And because of the U.S. budget bill, there should be quite a bit of fiscal stimulus pushing the U.S. economy forward as well through next year. So we think most of the weakness in the U.S. economy is behind it, but it still has another quarter or two of softness to go.
What about on this side of the border? We had the 1.6% for Q2 annualized. Is there more pain, do you think, to come? And do you expect the Bank of Canada to hold this month?
Well, we think the second quarter does mark the low point for Canada's economy. It effectively went from having one of the best performing economies among major advanced countries to basically the worst. By contracting by 1.5% annualized. But again, all that the weakness was largely concentrated in the trade impacted areas, exports falling 27% annualized, and business investment in machinery and equipment falling even more than that because Canadian businesses were concerned about trade policies and their impact on our economy. We think that's the worst for Canada's economy, though. We are encouraged by the uptick in the advanced GDP numbers for July, and we do think the economy will expand very slightly in the current quarter and then pick up a little momentum by the fourth quarter and then through next year, again, assuming trade tensions stabilize, tariffs stabilize, things don't get worse on the trade front. And we do assume plenty of fiscal stimulus on this side of the border as well. We'll find out with the fall budget. But importantly, we do expect the Bank of Canada to address some of the softness we're now seeing in our labor market by cutting interest rates, probably not in September because core inflation is still a bit sticky and above the 2% target. But by October, we do expect a rate cut and then expect 2 more rate cuts by the spring of next year. That'll push policy from neutral to stimulative territory, and that should give the economy a lift through next year.
Sal, I have to leave it there with you. I'm out of time. Sal Guatieri, Director, Senior Economist, BMO Capital Markets. Thank you.